So there were so many different tax changes that happened in 2026.
Starting after about the first quarter of last year, 2025, bonus depreciation got bumped back up to 100%. So anything with a useful life of 20 years or less can be written off.
Is there an end date at all?
No, it's been made permanent. So we've got that 100% bonus depreciation. So if you want to use that short term rental loophole, you got time now.
And give me an example of what that property looked like in terms of acquisition, but how
Mhm.
much they were actually able to write off.
So, just as an example, if you bought a $500,000 house and you were able to take 20% of that out with the cost segregation, that would be $100,000 of assets that you can take bonus depreciation on, which is immediately deductible in the year that you purchase it. So it is a time investment, but if you're willing to do that, it is a very, very powerful tax tool.
Let's talk about the SALT changes. So why does that matter?
In the past, it was limited to $10,000 for quite a while. Now that's jumped up to $40,000.
My name is Josh Baldovino. This is Jeff Fujikawa, who is a managing partner at Fujikawa and Associates. And this is Office Hours, a tax podcast all about helping you as investors and business owners save more. So it's 2026, and I know that your team's in full-on tax prep right now. But aside from all of that, Derek, there's also been some major changes this year. So what on the tax front has changed this year?
There's been quite a few changes with the new tax law that just passed last year. But a lot of it was extensions of things that were about to expire coming up in the next couple of years, or this year and next year. But there were some really big things that occurred with it. One, which is kind of an extension, but not really, was the bonus depreciation. So now, starting after about the first quarter of last year, 2025, bonus depreciation got bumped back up to 100%. So anything with a useful life of 20 years or less can be written off 100% with that bonus depreciation on the federal side. The other thing is the increased limitation for the SALT deduction, or state and local taxes. So on the Schedule A, and for the past 7-8 years, it's been limited to $10,000, and they just increased that up to $40,000. Now that does potentially phase out at higher income levels and can drop all the way back down to 10,000. But for a big portion of the people that file, you could deduct up to $40,000 of property taxes and state income taxes and DMV fees. And then there are a few other, maybe not so big things, like the no tax on tips and no tax on overtime, things like that. They phase out relatively low income, so it doesn't affect a lot of people, and there are some pretty strict limitations on a lot of those things. It's not maybe quite as great as it sounds on paper, but there are definitely new developments and things that people can use on their tax returns.
So I mean, the one that's still going viral ever since it kind of went through is the short-term rental loophole on
Hmm.
the bonus depreciation. A couple questions for you there.
Sure.
It's been extended again on 100% bonus.
Mhm.
Is there an end date at all?
No, it's been made permanent, so we've got that 100% bonus depreciation. So if you want to use that short-term rental loophole, you got time now.
And give me an example of another client who's used that in terms of kind of what that property looked like in terms of acquisition, but how
Mhm.
much they were actually able to write off.
Yeah, sure. We can kind of use a somewhat hypothetical situation. With cost segregation, I've seen about 15 to 20% of the cost of a property, single family home, as being able to be segregated out and used as that lower life assets where you can take bonus depreciation on. So, just as an example, if you bought a $500,000 house and you were able to take, say, 20% of that, as separate 20% of that out with the cost segregation as the lower lifespan assets, then that would be 20% of 500,000, $100,000 of assets that you can take bonus depreciation on, which again is immediately deductible in the year that you purchase it. So if you qualify for that short-term rental loophole where it qualifies as a business, then you could take that $100,000 deduction against your rental income. But if all of those expenses exceed the rental income, then that loss becomes an ordinary loss, which you can take against your W-2 income, your investment income, your other business income. So it could be a very powerful tool.
So if we were to kind of just obviously make some hypothetical numbers up,
Hmm.
but if you said 20% of that, that's $100,000 of 500,000.
Hmm.
Let's just say someone makes $200,000 a year.
Sure.
And yes, there's some income. Let's just, again, kind of generalizing it. If that
Hmm.
income produced $50,000 and there was a $100,000 loss in year one,
Hmm.
meaning you wipe that 50 out, and then now you have another 50 left over that you can now offset that 200K W-2 from.
Yes. So then you'd have a net $150,000 of ordinary income, and then your other deductions on top of that.
Which obviously you guys all see your pay stubs on your
Yeah.
W on a $200,000 W-2. You're paying a decent amount of
Yes.
taxes every single paycheck. So
Yeah, so that could potentially generate a fairly significant refund for you at the end of the
Okay. And you mentioned now it's permanent, which means I feel like a lot of people now are thinking, okay, how do I do one every single
Mhm.
year? Kick that can for as long as possible.
Yeah, you can. It's a lot of work. So, you do have to manage all these properties. So it is a lot of work. But if you can swing it, you could do it every single year and just buy a new short term rental property, keep adding it to your portfolio. And as long as you can satisfy the requirements to meet that short term rental loophole, then you can keep taking those big deductions with those cost segregation.
Okay. And then you mentioned a lot of work. What are
Mhm.
the requirements to material participate? Has anything changed there?
No changes there. It's 500 hours of active participation in the property or 100 hours and more than anyone else. So it is a time investment. Even that 100 hours, it has to be more than anyone else. You can't just spend 100 hours and hire a property manager that spends 300 hours a year, then you don't qualify. You still have to do the majority of the work on this property. It's not a buy it and forget about it and take a big deduction. It's something where you really have to put a lot of time in. But if you're willing to do that, it is a very, very powerful tax tool.
And then you also mentioned before the call that
Mhm.
we had a couple examples or a couple instances where the IRS not necessarily did a full audit, but looked a little bit closer. What
Yeah,
happened?
it's happened even before this with if you have a very large refund, the IRS will generally take longer to process your return and take a little bit closer look at it. It doesn't necessarily mean you're going to get audited, but there is a higher likelihood with a large refund like that. So you just have to be ready to have all of your documentation, especially the hours. Make sure that you have that well documented. You don't want to have more than 500 or 501 hours because if the IRS comes in and says, oh, these 5 hours don't count, then now you're below the minimum needed. So you want to make sure you have a pretty clean buffer so that in case they come in and say these hours don't count, you're still well above the limitation.
Anything else in terms of bonus depreciation? Anything that's changed or any other unique instances that you've seen other investors do in terms of this strategy?
Nothing unique. One thing to be aware of is California doesn't conform to it. None of this applies to California, so you're not going to be able to take these large deductions on your California return. For those of you that are in California, I know there's people outside of California. You want to check with your state too. If you're not in California, check with your state to see if it conforms. Some states just have a blanket conformity with the IRS, so they'll just take the IRS tax return and use that as their base. But states like California and others have their own full tax system, and they'll either conform to some or all or none of certain tax laws. So you just have to check to see what your state conforms with. And California definitely does not conform to bonus depreciation. It hasn't since it was incepted. You just have to take the standard. If it's a 5 year asset, depreciated over 5 years, or 10-year asset, same thing. So just be aware of that.
So even though we're all paying 10% in state income tax, we're not getting a
Yep.
chunk of that back then, huh?
No, 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 none of that.
Are there any ways to get a chunk of that back?
On the California side,
Yeah.
California is pretty strict on things. There aren't really any California deductions that the IRS doesn't have. I mean, they're talking about possibly bringing back things like the credit on the California only since it's gone on the federal side. But, things like that haven't passed yet. But there could be some differences like that coming down the road.
Let's talk about the SALT changes. So why does that matter to your average business owner, high income earner, investor?
For SALT, state and local taxes, in the past it was limited to $10,000 for quite a while. Now that's jumped up to $40,000. So it's a significant amount, especially if you're in a state that has a high income taxes or high property taxes, which California has both. Then most people were limited in what they could deduct in their, especially property taxes. So if you live in the Bay Area, you could pay 15, 20, 30, $40,000 in property taxes, and you lose majority of that if you're capped at $10,000, let alone your state income taxes on top of that. So now it's capped at 40,000, which there's still a lot of Californians that are going to be more than 40,000, but it's a much bigger deduction. So it makes your tax return a little more interesting because with the $10,000 cap, it just basically meant a lot of people were taking the standard deduction because it was a little over $30,000. But now that the SALT limitation is over 40, that's obviously more than the standard deduction. So if you get that and then you add in, say, smaller deductions like donations and things like that, even if you don't have mortgage interest, you may still be able to itemize.
Gotcha. So a
Mhm.
little bit more work on everyone's part,
Mhm.
ours and your team's
Yeah.
included, but that's obviously a significant jump. How about on like the business entity standpoint? Anything that's changed for LLCs or S corps or C corps at all?
Not really. Everything is pretty much as is. I guess still get a lot of questions as to if the people should incorporate or what type of entity they should set up. And in general, LLC is a nice starter entity. It's easy to set up. especially if you have multiple members or partners, then you can separate the income nicely. A lot of people ask, should I set up an S corporation? It's not necessarily always the best idea, especially if you're small and don't make a ton of money. Usually, if you're in the $75,000 to $100,000 range, it starts to make sense in terms of your profit from the business. If not, then all the administrative hassle of it kind of wipes out the tax savings. So you end up paying just as much in legal fees and accounting fees and payroll taxes and all that stuff to offset the potential tax savings.
The last question that I really had was if someone's listening and wants to make some smart moves. I mean, if someone's thinking about starting a business or a business legit this year,
Mhm.
what's the question they should ask you on that, or what things should they have prepared?
The entity selection is an important piece. So, and again, that depends on a number of factors. But that's the thing. Talking to an attorney, getting it set up properly. A lot of people just kind of fly out, work off the seat of their pants and just kind of start a business and don't really get it set up properly. So usually I'll say talk to an attorney, especially if you have multiple partners. You want to make sure it's set up correctly and everyone's covered on their end. You have your liabilities covered and make sure everyone is on the same page with everything. And then, you know, tax wise, just getting set up and making sure you have the optimal entity set up for however you'll be running your business.
And then any other general trends you're seeing in terms of your network at all? Are there more investors now that you know who are looking to purchase properties and short-term rentals because of the bonus or 1031? Kind of what trends are you seeing?
I'm seeing a little bit more purchases. I think it's still harder just because interest rates are still high. It's hard to make the numbers work, although that bonus does help. But again, the bonus depreciation is just the first year. You buy something, you want to take a long term look at something. First year deduction is great, but is it still going to pencil out 3 or 4 years down the road? If you're going to be constantly losing money, then the big deduction is a nice lure, but make sure it's still a good investment overall.
Totally, totally. I mean, I think that could be one thing that is easily overlooked. And,
Hmm.
from some of the meetups we've been hosting, people say, yeah, I want to do the short-term rental because I want to, get the big write-off.
Yeah.
But yeah, if you are bleeding $1,000, $2,000 a month on a property
Yeah.
after year one,
Yeah, and if the market's not appreciating rapidly, then you may not make that money back on the back end either. So the investment should drive it. The short-term rental loophole is a huge tax advantage, but as always, you want to look at the underlying investment and make sure that makes sense before you make the jump into anything.
totally. And then aside from that, and the underwriting side is also how much work do you actually want to put into the
Mhm.
short-term rental consistently?
That
And
500 hours is a pretty big hurdle. Like I mentioned to you before, I brought it up to a number of clients that always ask, how can I offset my W 2 income? And that's a great way to do it. But do you want to spend all that money? I mean, you got to put money down to buy something that's going to give you some decent cash flow and then put all that time into it. So it is definitely an investment, both time and money.
yeah, and then for anyone who's thinking about it, the time commitment is usually at the most valuable times to you. So it'll be
Mhm.
Friday nights, it'll be
Yes.
weekends, those are the
Yeah.
weekends, the middle of
Mhm.
something on the weekend, 'cause that's when the majority of your guests are.
The short-term rentals are generally weekends, right? Yeah. Or holiday time.
Yeah, yeah,
Yeah.
I know. I think, yeah, here's the caveat. I feel like every Christmas Day there's been a fire at one short-term
Oh no.
rental, and I still see it on my hours, but I have not had a Christmas Day where I haven't been coordinating
Yeah.
with the plumber, trying to get in there or something.
Yeah.
So the 2026 Christmas looks better.
We have midterm rentals and we have a property manager now, but when we were managing themselves, even those, I mean, less time intensive, but there was always something popping up at the most inopportune times. Oh, I just multiply that by a bigger factor when you have a short-term rental.
Well, obviously, again, I know we are like 2 weeks before March 15th deadline, and
Yeah.
there's the April 15th deadline, so I know that your
Yep.
team is crazy. Any other friendly reminders you wanna share out to the public just before it gets really, really crazy?
Just be kind to your CPA. Get your information in as soon as possible because it's going to get even crazier. That's all I have for now.
Well, if anyone's looking to make moves in 2026, make sure to please save this video,
Hmm.
share it, and of course, then go down the channel and look at everything else because we've talked about almost every single there is. And I've even given
Hmm.
live examples of our own investments
Hmm.
in terms of how they might pencil. But Derek, I appreciate you jumping
Yeah.
on in the crazy time.
Yeah.
And for anyone else, you have any questions, leave them down in the comments below.
Great.
Thanks, Derek.